Hello everyone. Thank you to Diver Asset Management for the opportunity to speak with your clients about India. My name is Siddharth Singh and I am from SBI Funds Management Limited, India's largest and most reputed asset management company. I am here to make an investment case for India, for investing in India. The world is going through a rough patch right now, but this is not the first time we have been here. Problems have always been there, only their nature have been different. The situation is not very different for India. Over the last 46 years, from the start of 1980s, India has faced multiple challenging phases, including things like Asian crisis, the tech bust of 2000, the global financial crisis, multiple wars, trade war, terrorist attack, COVID, demonetization. All these events happened. Yet the Indian economy has grown 22 times in the last 46 years. During the same period, the stock market rose 670 times. India is now the fastest growing major economy in the world and also among the top 10 largest economies. Now let's look at what it means for an investor on the next slide. I'm sure you'll be surprised. Let's move to the next one. This is probably the most interesting slide in the entire presentation. In this century, in about 26.5 years, let's look at how various economies and economic blocks have grown. China's GDP was about $1 trillion in 2000 and now it is about $17-18 trillion. So it has witnessed a phenomenal 17-18 times growth in the last 26 years. The world has never seen this kind of growth and probably will never see it again. Likewise, if you look at the US economy was about $9 to $10 trillion in 2000 and now it is about $28-29 trillion. The US has grown about 3 times. In that comparison, if you look at India was about $500 billion in 2000 and now it is nearly $4 trillion in size, which has registered about 8 times growth in the last 26 years. Now here's an interesting thing. Keep that growth in mind, and if you had invested $10 million in these economies on the 1st of January 2000, let's look at how much it would have become by the end of 2025. In China, a $10 million investment on 1st of January 2000 would have grown to $58 million by the end of 2025. This is about 5.8 times in the last 26 years. In US, a $10 million would have become $78 million, an increase of almost like 8 times. In an emerging market, if you look at, which has been doing very well over the last 2 years or so, a $10 million, the same $10 million would have grown to about $59 million, similar to about China. But here's the twist in the story. If you look at India, the same $10 million would have become $133 million, a phenomenal 13-fold increase. Remember, in the last 2 years, India market has not been doing so well. Otherwise, this would have been much higher. Now, let me add another twist to this whole story. A 13-fold increase in the last 26 years, despite the currency depreciating by over 100% in the during this period. So what does it show? Despite all the challenges, India is the most successful equity market in the world. Second, in the short term, the economy and the markets can remain challenging, but over time, if the companies are doing well, then the returns get generated. And thirdly, while economic growth is important, it is not the only important thing. The structure of the economy, the nature of the government, the nature of the growth, all these things are equally important. So why is India the most successful major market? Let's find some reason on the next slide. Now, you need 2 things for the stock market to deliver good returns. Number 1, you need a revenue growth. The second thing, that revenue should get converted to profits. The Indian equity markets are among the largest in the world in terms of number of listed companies. There are over 5,500 listed companies in the country. This provides a wide range of companies to invest in. Interestingly, if we look at the chart on this slide, companies falling in the 40th percentile and above are growing their revenues faster than the economic growth rate of the country. In fact, the 80th percentile companies are growing their revenues at more than 3 times the economic growth rate. There are so many companies that are growing their revenues faster than the overall economic growth rate. And let me give you an example here. There is a popular Japanese company which operates in the country that has grown its revenue by almost 3 times over the last 5 years, despite multiple disruptions, including COVID lockdowns, the Ukraine-Russia war, trade war, high inflation, high interest rate, and now the conflict in the West Asia. If your products are right, then the demand is there for almost everything in the country. Penetration rate for every product is quite low. For example, the car example that we were talking about, the car penetration is just about 34 cars per 1,000 population in India. Compare that to China, which is about 182 cars, and the world average is about 340 cars per 1,000. So likewise, category by category, you will find a similar story. And that's why India has the potential to become one of the largest consumer markets in the world. So if company has a right product, it can sell fast and generate revenues. Let's move to the next one. Secondly, these high revenue generating companies are not only limited to a handful of sectors, as in the US, where the concentration is quite high. In India, you will find such companies across sectors, including the old economy sectors like utilities, energy, industrials. Another key point about India is that despite high demand, the supply remains constrained. If the company is a niche player with a strong product and services, it will have the pricing power, which will translate into profitability or return on equity. India is is amongst the highest return on equity generating countries like the US. Shareholder returns are the key focus for the management here, because most of the companies are predominantly owned by families and have world-class managements. This profitability then drives the share prices. The other way to look at this is on the next slide. This is another interesting slide. Many investors fear India, believing that equity market is small, less liquid because of limited number of large liquid stocks. Before I get into this slide, let me remind you that India's economy is almost 7 times smaller than US and 4.5 times smaller than China's. In this context, the table on this slide shows that India has almost 840 stocks with market capitalization of more than $500 million, more than most of the other economies listed on this table, except for China A market and the US. What is even more interesting is the number of stocks that have delivered 5-fold returns over the last 10 years is next only to US. This is much higher than China, a bigger economy than India or any other economy listed here. Even more interesting is the fact in the last column of this table that shows that the consistent returns, that is 5 times in 10 years, 3 times in 5 years and 2 times in 3 years. Here, India beats every other economy despite its smaller size than China, the US, Japan or Germany. The opportunity to create wealth in India is immense. There are a lot of global companies that are listed in India, as India is a major hub for their businesses. For example, look at Maruti Suzuki, which is a listed company in the country. You know what? Its market capitalization is higher than its parent, which is listed in Japan. The next question on the investor's mind is always about the valuations of Indian market. So let's move on to the next slide. The simple answer about the valuation, whether it's expensive or not, I think the answer is yes. India has typically traded at a higher valuation. But an interesting fact is that despite trading at a higher valuations than emerging markets or most other markets, at most of the times, India has generated good returns for its investors, as we saw previously. So the game is not about timing the market for a cheaper valuation or waiting for the market for a cheaper valuation, but it is time spent in the market that will define the success. A longer time horizon helps counter higher valuation. There are multiple reasons why India typically trades at a premium. One, of course, is its high growth. The other is the quality of its high growth. The other reasons include quality of companies, their management, the under-penetrated market. When we talk about valuations, we typically refer to index level valuations, which is based on select few companies. a few expensive stocks with high weight in the index can make the valuations look expensive. Secondly, think about it. By calling the market expensive, are we saying that the entire investable universe of over 5,500 companies is expensive? Not really, to my mind. Right? So the beauty of India is that you can find mispriced stocks at all points in time and across every market cycle. The chart on this slide shows that as the economy expands, new businesses form and they typically enter the index after their solid performance when their valuations have got expensive. At the same time, the companies which are getting replaced are typically those companies that have not performed well and are trading at a lower valuation than the ones that are getting added. So this interaction between adding new stocks at high valuation and removing old stocks at lower valuation makes the index look expensive. As I said, despite trading at expensive valuations, India has performed well over longer periods of time. So let's look at what is the present valuations saying about the current state of India. At this point, India has corrected over the last 2 years from September 2024 because of various global factors such as trade war, the real war, its premium over. So if you look at the valuations today, the premium over the EM is around now at around 15-16 years average. Because of the recent correction that we have seen in the market, we are seeing price correction and the time correction that has happened in the market. And there are many interesting ideas where one can allocate to make some serious money over longer term. So let's move to slide number 9. Now, finally, I think India is a very good complement to your existing investment portfolio. As you can see on this slide, India is a good protection against a volatile global environment. It is a low beta play, and the beta has been consistently declining. Structural factors such as macroeconomic stability with declining primary deficit, falling inflation, mid to high teen annual growth, earnings growth over the medium term supported by capex cycle, leveraging of corporate balance sheets, a rise in discretionary consumption. There is a lot of reforms that are happening in the country. They have all reduced India's beta to the EM. Now, this is whatever we have spoken till now, this is all about past. This is what India has done. Now, what is very important is to look at the future, how we see India going forward. So I'm going to put down some building blocks in front of you. And this is another very interesting slide, which is slide number 10. Now, this noodle chart, it shows various economies and the economic blocks, how they have performed since 1970s till 2024. It shows the decadal progress of each country's GDP as a percentage of world GDP on the y-axis, while the x-axis represents that countries or economic blocks' contribution to the incremental world growth. Look at the US first. At point A on pink line, which is like the decade of 1970s, the US economy accounted for almost like 28-30% of the world economy, and its contribution to the incremental world growth was almost 24-25%. In fact, its contribution to the incremental world growth reached almost 28-30% in the 1980s, the next black dot on the pink line. However, the recent decades, we have seen it has been falling, and look at point E on the pink line. Likewise, if you look at Euro, almost like 27 countries, but its share to the world GDP as well as contribution to incremental growth has consistently fallen over decades. Just compare point A on the orange line to that of the point E on the same line, which is 70s with the current line. Likewise, you can see other countries on the chart with the same conclusion as that of US and the Euro, except for India and China. Now, with the slower economic transition and inherent weaknesses well exposed to the world, along with issues in political structure and aging population, investors are less enthusiastic about China than before. As noted on the earlier slide, strong economic growth did not translate into better stock returns for China for investors due to the same issues. While the case with India is very different. Its share of the world GDP and its contribution to the world growth are both rising. I think the long-term mega trends in India will continue to drive the global growth going forward. Before I talk about 5 mega trends or the force vectors as we call them, let me digress a bit and share a simplest story about India, which will, I think, give you confidence to invest in the country. India's per capita income is just about $2,800, well below China's $12,500. The world average is about $15,600. Imagine a scenario where India's per capita income goes up by just 50%. That is, it adds $1,400, which is not a big, addition to the entire per capita income. Now, this incremental $1,400 will accrue to 1.5 billion people, the entire population of India, which will add about $2.1 trillion to the Indian economy over the next couple of years. Now, just to put this $2.1 trillion to Indian economy, what I'm saying is that India is going to add one Mexico to its economy in the next couple of years. So there is a lot of investment opportunity that are going to come to India. Now, why India can do but other can't? There are 2 reasons, I think. First, in India's case, the base is quite low, so the compounding can be easier as compared to other countries where the base is high. The second reason why India can do is because of the mega drivers, and now I'm going to talk about these mega drivers which will propel the growth going forward. The first is country's demographic profile. As you know, India is a young country with a median age of less than 30 years. There are approximately 400 million people in India in the age group of 15 to 29 years. This is more than the entire population of US and 3 times the population of Japan. At a basic level, it means that there are more people in the earning group than those who are not earning due to age. Economists call it as a dependency ratio. So for India, the dependency ratio is falling down. What it also means is that these people will enter the workforce, form households, and thus spend on almost everything. Consumption demand will go up. Now think about it. As these people move to cities and build their own houses, the investment demand will also go up. Secondly, there is another interesting shift that is happening in the demographic profile of the country. More and more women, who are almost 49% of India's population, are entering the workforce. Women now account approximately 40% of all bank accounts and contribute almost 40% to total deposit. Similarly, women participation in the capital markets is also rising. So what it means is that demand is now shifting towards women-centric products and services. So the companies who are catering to women are seeing phenomenal growth. For example, the per capita spending on beauty products is between $10 to $15 in India. But if you compare it with US spends almost $200 and China spends almost 4 times that of India's spending. So there is a company which is servicing this kind of demand, and it is witnessing a good growth. Likewise, the white goods penetration in the country is significantly lower than US and China. For instance, if you look at washing machine, it is only 15% in India. The refrigerator is only 20% in India. But if you look at China and US, it exceeds 90%. So category by category, you will find a similar trend. So this is a huge opportunity for investors. The second mega driver is urbanization. India's urbanization rate is only 35%, and if you compare it with China, which is about 65 to 70%, this means that as more people start earning, they will start moving to cities. Every minute, 20 people migrate from rural to urban areas. This is putting enormous load on our existing cities. We need to build more satellite cities, what China has done, to cater to the rising demand. More roads are needed, more urban mobility system, metro rails, train services, water services, hygiene, etc. is needed. Now let me give you a few examples here. Despite having the biggest population and a low urbanization rate, our per capita cement consumption is just around 300 kgs, when the global average is at about 500 kgs and China is almost 5 times of India, which is at 1500 kgs. This is not only about cement. If you look at steel, the story is very similar. So demand for all these will increase significantly. Secondly, it is not only about the physical infrastructure, it is also about the digital infrastructure. If you must have heard about India's online payment system called UPI. It is now the world's largest payment platform, processing over 20 billion transactions each month. What it has done is it has opened up and connected small businesses with consumers, improving the efficiency and connecting them to the banking system. These small businesses have come under the banking system, and the banks can today see what is the business that they are doing, and they can provide credit to these smaller businesses to grow and expand. The third mega driver is energy. If an economy is growing fast, it needs a lot of energy. This is probably the weakest link for India because most of the energy is imported. If you look at some of the numbers, 90% of the crude that we consume is imported. 60% of our gas requirement is also imported. This is a huge requirement, even though both accounts for just about 32% of energy basket. The recent conflict in West Asia has exposed our weaknesses. India is set to account for 25% of global energy demand, driven by rapid urbanization and industrialization going forward. Here's another example. India produces 20% of world data, but has only 3% of data center capacity. Now, setting up data center needs a lot of energy, and global companies have committed large sums of money to India. Now, the flip side of this is that if you consume a lot of energy, we will also pollute the environment, as energy and environment are two sides of the same coin. Therefore, we not only have to invest in energy sources, but also in cleaner energy. This is where a lot of work is going on in terms of solar, hydro, nuclear, green hydrogen, ammonia, etc. Currently, renewables account for slightly over half of India's total installed power generation capacity. The fourth mega trend is the shift of trade and supply chains. Two episodes are driving are driving factors here. The first one is the global discomfort with China, especially post-pandemic. And two, the trade is being weaponized, leading to fragmentation of globalization, as we have seen in the recent trade war. Here again, India is in a sweet spot. India is one of those rare emerging markets that imports more than it exports. And what it imports is commodity. So if the world is in a problem, the commodity prices fall and India benefits. We have seen this in recent times post-COVID. But what it exports is something very phenomenal. It doesn't export commodities like other emerging markets. It exports high-tech items like IT services, pharmaceutical, engineering goods, which are kind of resilient to economic shocks. I would like to give two examples here. India has the largest number of FDA-approved pharma facilities outside of US, and this is the largest single source of generic drugs for the US market, providing nearly 50% of all generics. Second, look at IT. Today, Indian IT firms serve almost like 90% of Fortune 500 companies. 5 of the top 10 IT firms in the world are Indian companies as per brand directory. Indian IT sector employs over 5 million people to meet global IT-related demand. India is also the capital of global capability centers where leading firms across the world are establishing their R&D and major operations. GCC, Global Capability Center revenue have reached nearly $100 billion. Now this is a virtuous cycle. It is generating employment, which is driving consumption, and this in turn is increasing demand for capital expenditure and real estate. So India, being a friendly nation that has never attacked any country in its history, stands to gain because the world needs a reliable supply chain partner. Finally, the fifth mega driver is geopolitics. Now, this is one very important ocean. There is one very important ocean in the world which is named after a country. It is called Indian Ocean and it is named after India. Now this connects Africa with Eastern world. There are almost 3 billion people living around the Indian Ocean and it is a vital maritime route. Almost like 1/3 of global bulk cargo and 2/3 of its oil shipment flows through this ocean. Now India, given its strategic position and advanced naval power, is a major player in the Indian Ocean region. The West and the countries in the East, they depend on India to maintain its security. So what is the implication of all this? To counter China, both West and the East need healthy India. So they are investing in the country. Companies like Apple, Boeing, and those from East such as Suzuki, Honda, Toyota, LG, Samsung, they have large operations in the country. Similarly, companies like Google, Amazon, etc., they are also using India, a friendly country, to set up massive data centers. So there is lots happening in the country. The undercurrent is quite strong. Now you should look at India not just as a country to generate 8 to 10% returns. Instead, you should look at India to multiply your capital. I'll give you a recent example here. A global air conditioning firm called Carrier, they said recently, and I quote, "We don't look at India on a year-on-year growth basis. Instead, we think in terms of multiples. How do we achieve 2x, 3x growth in India?" Unquote. Now let me move to another burning point, that is foreigners are withdrawing from India market. So if the simple answer for this is that is right. The foreigners are withdrawing their money from the capital markets, and there are a couple of reasons. The first is they might be seeing opportunities elsewhere, and this is quite normal. They think in relative terms because they have the whole world to invest. Maybe for them another market looks cheaper and offers more value for their money. Also today, the second reason is the money is chasing today AI related themes, and unfortunately India is clubbed as an anti-AI play. Now there are 3 important points I want to mention here. First, investors closer to the ground, that is the local investors who can see progress and opportunities on the ground, they are a big force in the market today. They are large investors into Indian equity markets and they are investing multiple times of what foreigners are withdrawing. This is providing stability to the market. Retail investors are putting close to about $3 billion every month through systematic investment plan route into domestic equities. Second, in our opinion, India would be a great AI play going forward. The latest research on AI indicates that the AI theme is shifting from model makers, which are mostly based in US, to infrastructure and diffusion. So India, with its stretched public system and around 80 million micro, small, medium enterprises, stand to gain significantly from AI-enabled productivity gains at a population scale. Third, foreigners are withdrawing from the Indian capital market because they have made money, so they are booking profit. And at some point in time, they will start coming back. Remember, it is not the foreign direct investment which is more important than the capital market flows that is going out. In fact, several companies are establishing their facilities in the country. Like Carrier, for example, a global AC player, is investing around $100 million to expand its capacity in the country. Similarly, Maruti Suzuki is running out of capacity and will be forced to invest soon. So let me share another interesting fact. If you look at history, foreigners pulling out of the market, out of the India market, is basically a contrarian indicator. When they withdraw, after some time the market's running. So let's move to the next one and let's look at how retail investor participation is going in the market. Retail investors, as I said, are a major force in the market today. They are investing through systematic investment plan. So they are investing close to about $3 billion every month, which is providing stability to the whole market. Finally, I want to provide some reassurance on the external front, and this is on the next slide. India has one of the highest foreign exchange reserves in the world, which can cover almost 10 to 11 months of import. Just to give you some historical perspective, when India was categorized as one of the fragile 5 economies in 2013, our foreign exchange reserves were just about $300 billion. The current reserve stands at close to about $700 billion. India is in a much improved position than it was at any time in the past. But still, the currency has depreciated. I think there are 4 reasons for that. Number 1, as I said, foreigners are taking out money from the equity markets for various reasons, as we discussed earlier. This is putting pressure on the currency. 2, likewise, because of the tough global macro environment, the FDI flows have slowed down. These 2 factors are raising doubts about India's ability to fund the balance of payment. Thirdly, an unsettled global environment. First, it was due to ongoing trade war. Now it is due to geopolitical factors. India runs a current account deficit. We import more than what we export, and we tend to suffer in such times. And lastly, the uncertainty on the crude and the commodity prices due to global factors is making investors nervous. If crude stays higher for longer, definitely it will impact the economy. This is leading to some shift away from India, putting pressure on the currency. However, I think India macroeconomically is in a good shape. The damage to the core should not be excessive. In fact, let me share another interesting fact. You may not have realized that despite currency depreciation against US dollar, Japanese investors have earned around 14% CAGR in yen terms from India over the last 5 years. This effectively means that you would have doubled your money in the last 5 years. So now let me just quickly sum it up on slide number 14. At this point in time, the Indian economy is holding up pretty well despite the global disruption. This is underpinned by sound macroeconomic condition. As a word of caution, the longer the war lasts, the greater impact it will have on the economy. We are watching it very closely. The Central Bank of India, the Reserve Bank of India, in its last monetary policy at the start of this month, projected about 6.9% economic growth, the GDP growth, for this financial year, and with a projection of rising inflation, but well within its tolerance band. Likewise, if I look at economic advisor to the Government of India, they expect the economy to be fine if the crude is priced at about $90 per barrel. But if the crude prices rise to about $130 per barrel and stays there for 2 to 3 quarters, it will affect the growth, inflation, and the current account deficit. So that will put stress on the economy. And finally, even though the street has started cutting earnings expectation due to the conflict in the West Asia, we expect the earnings to be in the range of about 13 to 15% over the next 2 years with wide sectoral dispersion. This makes India a perfect bottom-up stock pickers market. So before I end my presentation, let me sum it up. India took about 60 years after independence to become a $1 trillion economy. But the next $1 trillion was added to its economy in only 7 years. The third trillion was added in less than 7 years. And finally, the $4th trillion was also added around the same time. Going forward, as the progress continues, India is expected to add $1 trillion to its economy in a shorter period. So the best days for India are ahead. Please focus on India's long-term growth potential. Thank you so much for your time.